Now, we try to access the dividend policy. We want to know how much cash is too much. So we have two approaches to access dividend policy. Approach number one, the cash or trust nexus, right? Access how much cash the firm has available to pay in dividends. Relative what it returns to stockholders. Evaluate whether you can trust the manager of the firm to keep your cash. And approach number two, peer group analysis. You just look at the industry average, about what industry average of dividend payout, okay, dividend policy, and you set your dividend policy, regardless of the peer group or industry average. So we'll talk about approach number one, okay, cash or trust assessments. So there's some steps, right? Step one, how much did the firm actually pay out during the period in question? Step two, how much could the company have paid out, right, during the period under the question? And step three, how much do I trust or you trust management of this company with excess cash? Once they have excess cash, do you trust them? So a measure of how much a company could have afford to pay out, how do you find that? You got to find what we call free cash flow to equity. So this free cash flow equity is the cash flow that available to common stockholder, right? And here is the formula to get free cash flow to equity. Net income adjusted with depreciation and amortization equals to cash flow from operation to equity investor minus preferred stock dividend minus capital expenditure, right? Because this will go net to common stockholders. Subtract with working capital needs, subtract with principal repayment. Maybe you call your bond, right? Maybe you call your preferred stock as well. So you have to subtract with principal repayment and add with proceed from new debt issue. Once you issue new debt, the cash or the proceeds should be added into the free cash flow to equity so that you get free cash flow to equity or FCFE. So here is Walt Disney FCFE, right? You see from year 1999 to 2008, right? You got net income, second column, third column, CapEx, fourth column, depreciation, fifth, change in working capital, sixth, change in net debt, right? And you get FCFE, right? So you can follow the equation to get FCFE. And once you get FCFE, you compare with the actual cash that Walt Disney pay out, right? The cash return you see is equal to dividend plus the buyback, okay? So you can compare between cash return, actual cash return with the FCFE, right? Ability to pay. How much could the firm have paid, right? As as the distribution. So compare with the cash return, you see the difference, right? Okay.